Welcome to Market Brief After Hours. We have a packed show today, diving into a trading session that was heavily shaped by a sudden surge in oil prices, a surprisingly divided Federal Reserve, and a market holding its breath for big tech earnings. It was definitely a cautious day across global markets.
It really was. We saw a lot of defensive positioning today. Investors are trying to balance a multitude of competing narratives. On one hand, you have the excitement around artificial intelligence and corporate earnings, but on the other, you have resurfacing inflation fears driven by geopolitical tensions and energy shocks. It's a delicate balancing act, and you could see that tension reflected in the major indices.
Let's get right into those numbers. The Dow has been taking a bit of a beating lately, hasn't it?
It has. The Dow Jones Industrial Average extended its losing streak to 5 consecutive days. It fell 0.57%. Dropping roughly 280 points to close at 48,862. That decline was largely driven by rising oil prices and higher Treasury yields, which really pressured risk appetite. Investors were definitely seeking safety.
And how did the broader market hold up compared to the Dow?
The S&P 500 showed a bit more resilience, though it still ended in the red. It slipped just 0.04% to finish at 7,136. It's holding near record territory despite the tightening financial conditions. There was some noticeable strength in selected industrial and semiconductor stocks, which helped offset the weakness we saw in other sectors.
What about the tech-heavy Nasdaq? Everyone is waiting on the rest of the Magnificent Seven earnings.
The Nasdaq actually managed to inch higher, creeping up 0.04% to finish at 24,673. It was a fractional gain, but again, certain semiconductor stocks did the heavy lifting. There are some lingering concerns about whether the massive investments in artificial intelligence are sustainable, so all eyes are going to be on those upcoming mega-cap tech earnings to justify current valuations.
Let's pivot to the Federal Reserve. We had an interest rate decision today, and while the outcome was expected, the details behind the vote were quite surprising.
That's exactly right. The Fed left interest rates unchanged in the 3.50% to 3.75% range, which the markets had fully priced in. However, the real story is the vote itself. It was an 8-4 split. We haven't seen dissent that sharp since 1992.
What is driving that level of internal disagreement?
It comes back to inflation risks, primarily driven by higher energy prices. Some members are clearly worried that inflation is re-emerging. On top of the rate decision, we got some interesting leadership news. Jerome Powell mentioned he expects to remain on the board after his term as chair ends in May. Meanwhile, Kevin Warsh is increasingly being viewed as the leading candidate to succeed him. So the market isn't just trying to guess the timing of future rate cuts anymore. They are also trying to price in a whole new leadership era at the central bank.
You mentioned energy prices being a catalyst for the Fed's inflation fears. Let's talk about oil, because the moves there were massive today.
Massive is the right word. U.S. West Texas Intermediate crude jumped a staggering 7.17% to settle at $107.16 per barrel. Brent crude wasn't far behind, rising 6.78% to $118.80.
What triggered such a violent spike?
It's heavily tied to geopolitical developments. Prices accelerated after reports surfaced that President Donald Trump intends to maintain a naval blockade of Iran until a broader nuclear agreement is reached. Any disruption around the Strait of Hormuz instantly intensifies concerns over global supply flows. When you combine that with the inflation data we are seeing, it makes investors incredibly nervous.
Speaking of data, we also had some mixed economic numbers out of the U.S. today regarding durable goods and trade.
We did. Durable goods orders actually rebounded nicely, rising 0.8% in March to $318.9 billion. That beat expectations of a 0.5% increase and reversed the decline we saw the prior month. However, the goods trade deficit widened to $87.9 billion from $83.5 billion, as imports grew at a faster pace than exports. We also saw Treasury yields react to the Fed's hold and the inflation fears. The 10-year yield climbed more than 6 basis points to 4.416%, and the 2-year yield rose over 9 basis points to 3.937%.
We are going to take a quick break. When we come back, we'll look at how international markets are digesting this energy shock, and we will dive deep into the technicals of the Forex and commodities markets. Stay with us. Welcome back to Market Brief After Hours. Before the break, we discussed the U.S. markets and the surge in oil. But this energy story isn't just a U.S. issue. European markets took a noticeable hit today, and a big part of that was a major announcement out of the Middle East.
Yes, the geopolitical shifts are complicating the global energy outlook. The United Arab Emirates announced its intention to exit the OPEC cartel. That is a massive structural change for oil markets, and it introduced a fresh wave of uncertainty. The pan-European Stoxx 600 index retreated 0.7% as a result.
How did that play out across the specific European countries?
It was a broad-based decline, completely overshadowing a flurry of corporate earnings. Germany's DAX 40 fell 0.3%, which is its 8th consecutive day of declines, putting it at its lowest point since mid-April. In the UK, the FTSE 100 shed 1.26% to finish at 10,202. France's CAC 40 dropped 0.39%, and Italy's FTSE MIB declined 0.51% to 47,796. The Swiss SMI also shed 0.88% after giving up some early gains.
It sounds like sentiment over there is quite fragile right now.
Very fragile. Euro area consumer confidence was confirmed at a multi-year low of negative 20.6 for April. Italy's consumer confidence fell to 90.8, its lowest since March 2023. Plus, preliminary data from several German states suggests national inflation could accelerate again due to these rising energy costs.
Did Asian markets mirror that pessimism?
Asia was actually a mixed picture. China's Shanghai Composite rose 0.71%, and Hong Kong's Hang Seng had a great day, rallying 1.68% as lithium battery shares advanced. South Korea's KOSPI is the real standout, though. It gained 0.75% to reach a fresh record close of 6,691, driven by relentless enthusiasm for memory chips and AI demand. But on the flip side, Australia's ASX 200 slipped 0.27%. They had inflation data show price pressures re-accelerating to an annual rate of 4.6% in March, up from 3.7%.
Let's shift gears to the foreign exchange and commodities markets. I know you've been watching the technical indicators closely, specifically the moving averages, which are telling quite a story today. Let's start with the euro to US dollar pair.
The Euro USD pair is looking very fragile in the near term. It closed at 1.1675, down 0.31%. It failed to hold gains above its 100-day simple moving average at 1.1708, and it finished almost exactly on its 200-day moving average at 1.1676. If it breaks below that, the 50-day moving average at 1.1649 is the next layer of support. Momentum is definitely softening there.
How about the British pound?
GBP USD also eased lower, ending down 0.30% at 1.3476. The price slipped back toward its 100-day moving average at 1.3465. Below that, you have an important support cluster formed by the 200-day moving average at 1.3415 and the 50-day moving average at 1.3408. The recent recovery is still intact, but the buyers are losing steam.
And the New Zealand dollar saw a pretty sharp breakdown today.
It did. NZD USD was down 0.93%, settling at 0.5831. This was a notable technical deterioration because it fell sharply through three key indicators: the 100-day moving average at 0.5870, the 50-day at 0.5862, and the 200-day at 0.5841. Sellers are firmly in control of that pair right now.
On the flip side, the US dollar to Japanese yen pair had a major breakout.
Yes, USD JPY pushed up 0.49% to close at 160.40. It ended firmly above that psychological 160.00 threshold. It remains comfortably above its 50-day moving average at 158.48, its 100-day at 157.24, and its 200-day at 153.89. The trend structure there continues to heavily favor buyers.
Let's look at the metals. Gold and silver both took a hit. What are the moving averages showing there?
Gold closed down 1.07% at $4,547. It is confirming a softer medium-term structure because it remains below its 50-day moving average at $4,849 and its 100-day at $4,740. However, it is still trading above its 200-day moving average at $4,245. It's testing the $4,500 region right now, which traders are watching closely. Silver fell even more sharply, down 1.90% to $71.64. It was rejected near its 50-day moving average at $78.44 and its 100-day at $78.92. It is still above its 200-day moving average at $61.80, but short-term momentum is under a lot of pressure.
Before we wrap up, we need to cover the big market movers today. Earnings season always brings some wild swings, and today was no exception. Let's look at some of the companies that struggled.
Robinhood had a tough day, tumbling 13% after their first quarter results missed expectations, reporting earnings of 38 cents per share. Teradyne sank even further, dropping more than 19% after issuing soft second quarter revenue guidance of $1.15 billion to $1.25 billion. We also saw GE Healthcare lose more than 13% after they cut their full-year adjusted earnings outlook down to $4.80 to $5 per share.
But it wasn't all bad news. There were some massive winners today as well.
Absolutely. Bloom Energy was a standout, surging more than 27%. They lifted their full-year revenue forecast significantly, up to $3.4 billion to $3.8 billion. Generac Holdings also had a great session, gaining more than 16% after reporting first-quarter net sales of $1.06 billion, which beat expectations. And finally, Visa helped keep the Dow from falling even further. They advanced more than 8% after posting second-quarter net revenue of $11.23 billion, comfortably beating consensus forecasts.
It is certainly a complex environment out there. Between soaring energy costs, a divided Fed, and the ongoing artificial intelligence narrative, volatility seems to be the only guarantee. We will be watching those remaining Magnificent Seven earnings very closely. Thank you for breaking it all down. If you find this useful, please follow Market Brief After Hours.